Imagine a company that has not just survived, but really thrived for 135 years. Now, this isn't just some old business, it's a financial giant. It insures everything from, your personal car to massive global corporations, manages trillions in assets, and consistently reports record profits, even amidst all the global uncertainty we've been navigating.
Yeah, it's quite the profile.
Today, we're taking a deep dive into just such a company, Allianz SE.
That's right. And you've given us a really comprehensive stack of sources here. We've got financial reports, strategic plans, crucial market insights. It's a lot to unpack. Our mission, as always, is to, cut through that complexity, pull out the most important nuggets of knowledge, connect the dots, and give you a really clear, concise understanding of this financial services powerhouse.
Exactly. Our goal here is to really shed some light on how Allianz manages to navigate a world wrestling with, persistent inflation, rising interest rates, significant geopolitical shifts. It's a lot.
It really is.
We want to understand how they consistently deliver these exceptional results and, importantly, a strong return to their shareholders. Along the way, we might uncover some surprising facts and maybe some aha moments about one of the world's most influential financial players.
Sounds good. Let's jump in.
Okay, so when we talk about the bedrock of the global financial system, Allianz's name inevitably comes up. It feels like more than just a big company. It's almost an institution, right? With this remarkably deep history.
Absolutely. And the real insight here, I think, is that Allianz SE, headquartered in Munich, Germany, boasts an incredible 135-year history. Just pause on that for a second, 135 years.
It's hard to fathom sometimes.
Right. Navigating world wars, economic depressions, recessions, booms, countless technological revolutions. This longevity isn't just a number. It speaks volumes about a deeply ingrained, almost institutional-level resilience and an unparalleled capacity for systemic adaptation through every conceivable economic cycle. It's really a testament to enduring strength.
And the sheer scale of their operations, that truly brings that insight home. We're definitely not talking about a regional player here.
Not even close.
For fiscal year 2024, Allianz Group reported a staggering total business volume of $179.8 billion.
Huge number.
Huge. And that impressive top line translated into a record operating profit of $16.0 billion and shareholders' core net income of $10.0 billion. I mean, these are enormous figures.
They really are.
And they're serving millions of customers across more than 70 countries with a workforce exceeding 156,000 employees. This global footprint, this incredible spread, it has to be a key factor in their ability to absorb localized economic shocks and maintain stability.
Indeed. It's precisely this global reach and the strategic diversification across different economies and regulatory environments that forms a natural hedge. It allows them to remain robust even when one particular region faces, significant headwinds.
Right.
What this really highlights for you, the listener, is how truly diversified global companies can achieve a level of stability that more localized players simply cannot. It makes them uniquely resilient.
And that resilience isn't just about geography, is it? It seems fundamentally baked into their core business model. They operate on what I kind of think of as a tripartite structure, almost like a three-legged stool, which gives it that inherent stability.
That's a great analogy. The company's resilience is built on three core distinct pillars: property casualty, or P&C, insurance.
Okay.
Life health, or LH, insurance.
Right.
And asset management, which we'll just call AM. This diversified model lets Allianz provide a truly wide spectrum of services. They cover everything from, protecting your personal car or home, to helping you save for retirement, to managing vast investment portfolios for institutions globally.
It's a huge range.
Yeah, and this mix provides inherent strength by balancing different revenue streams, different capital requirements, and different market sensitivities.
Okay, let's dive into each of those pillars then, starting with what looks like their biggest profit engine.
Sounds good. P&C is the place to start.
Okay, let's look at the P&C segment. Now, this is the largest component for Allianz by volume, and it's also the primary driver of their overall profitability based on these reports. In 2024 alone, it generated $82.9 billion in business volume and an impressive $7.9 billion in operating profit.
Right. And what's truly fascinating here isn't just the sheer size, but the breadth of what P&C actually covers. It's everything from personal auto and homeowners insurance, which most of us are familiar with, to huge commercial liability, property coverage for corporations, and even highly specialized lines like marine and aviation insurance. Think container ships, Think airplanes.
Wow.
Now, the key insight into this segment's strong performance, as detailed in the reports you provided, is their disciplined underwriting and successful price adjustments.
Okay, what does that mean in practice?
Well, it means they're not just selling policies to anyone. They're very carefully assessing and selecting the risks they take on. And crucially, they've been remarkably successful at raising prices effectively in response to rising claims. Inflation, think higher repair costs, more expensive building materials, and an evolving, often more complex, risk landscape.
So they're passing on those higher costs.
Exactly. And this demonstrates how a company can not only maintain but actually improve profitability, even when its underlying costs are rising. It's a clear testament to their operational discipline and, frankly, their market power.
Okay, moving on to the second pillar, life health insurance. This segment seems to have shown a really smart strategic pivot. Historically, LH businesses could be quite sensitive to interest rate fluctuations, right? But Allianz looks like they've proactively shifted towards more capital-efficient products.
Precisely. They've strategically pivoted towards products like unit-linked investment policies, where more of the investment risk is actually passed to the customer, and pure protection products, like term life insurance.
Ah,
This move significantly reduces their direct sensitivity to the ups and downs of interest rates, which is absolutely crucial in today's, well, let's call it dynamic rate environment.
and the numbers back this up.
Oh yeah, the numbers clearly show this strategy is working. In 2024, it recorded $81.8 billion in something called present value of new business premiums, or PVNBP.
Okay, PVNBP, what exactly is that measuring?
It effectively measures the profitability and value embedded in the new insurance policies they've sold, not just the sheer volume of premiums collected. It's about quality, not just quantity.
Got it.
This, along with a record operating profit of $5.5 billion and a healthy new business margin of 5.7% in 2024, indicates remarkable success in shifting towards these more profitable product lines. Lines that create sustainable long-term value rather than just chasing premium volume at any cost.
And then there's the third pillar, asset management. This is where you find some really big, well-known names in the investment world, like PIMCO, they're the fixed income specialists, and Alliance Global Investors, or AGI, which covers broader active strategies.
Right. And this segment is particularly interesting because it's a significant source of stable, fee-based income, and importantly, it's less capital-intensive than the insurance businesses.
Meaning they don't have to hold as much capital against it.
Exactly. What's truly impressive here is its sheer scale and consistent performance. At the end of 2024, it managed an incredible $1.9 trillion in third-party assets under management. That's 3 PAUM.
1.9 trillion euros. Just staggering.
It really is. And it generated $3.2 billion in operating profit. Even in volatile markets, the strong net inflows of $84.8 billion in 2024 highlight the enduring strength of the Allianz brand and the attractiveness of its investment offerings, particularly PIMCO and AGI.
Right.
It's a testament to their expertise in managing money effectively for a diverse global clientele, generating consistent revenue without tying up as much of their own capital. ### geographic reach.
So we've talked about the diversification across business lines, those three pillars, but this global powerhouse isn't just diversified by what it does, it's also incredibly diversified by where it operates. Can you tell us a bit more about their global footprint beyond their German roots?
Yeah, absolutely. Take their P&C retail business, for example. It's remarkably diversified geographically. While Germany is nationally their largest market, making up about, say, 26% of that segment's volume,
Okay.
the rest is spread pretty widely across Central Europe and Switzerland, around 14%, Iberia and Latin America, 12%, UK and Ireland, 11%, Asia-Pacific, another 11%, Italy, 9%, and France, also 9%.
So it's really spread out.
It is. The critical insight here for you is that no single region dominates. This creates a truly robust, natural hedge against localized economic downturns. It means a slump in one market isn't going to sink the whole ship, giving them unparalleled stability compared to more regionally focused players.
That's incredibly important. But you've mentioned before, sometimes there's a bit of a gap in what we can actually see in these reports, particularly when it comes to a comprehensive geographic breakdown across all the segments.
And this actually highlights a little blind spot for us as analysts and for you, the listener. While we know they're globally diversified, getting a precise consolidated breakdown of exactly where all that revenue and operating profit originates across all three business segments isn't clearly laid out in the provided reports. It's a bit like knowing a company is global, but not being able to pinpoint exactly which corners of the world are its biggest profit engines at the group level.
Yeah.
It's a small piece of the puzzle we just don't have enough data to complete for a truly granular geographical risk assessment. It introduces a slight area of uncertainty.
Okay, so we've just unpacked how Allianz built this incredible resilience through diversification, business lines, geographies. But even a 135-year-old giant can't just, rest on its laurels in today's rapidly changing world. So how is Allianz internally adapting and evolving its strategy to not just survive, but thrive in these complex environments?
That's a crucial question. And Allianz actually spent years on a big multi-year program they called Simplicity at Scale.
Right, I remember reading about that.
Yeah, this was all about internal transformation. Streamlining operations, simplifying product portfolios, harmonizing IT platforms, and really leveraging their massive global scale to drive efficiency, getting their own house in order, so to speak.
And the reports suggest those efforts really paid off, didn't they?
They absolutely did. The benefits are visible. You can see it in improved expense ratios and overall productivity, which directly flow through to the bottom line. This simplicity at scale was a necessary foundational step.
Makes sense. You need that solid base.
Exactly. You can't effectively pivot to external engagement and growth if your internal processes are fragmented and inefficient. So what they've done is really created a robust, efficient operating platform that gives them a strong base to build from.
And building on that, CEO Oliver Bett has articulated a new 3-year plan for 2025-2027. And this seems to pivot the focus from those internal process efficiencies to external engagement. It's all about transforming Allianz into what he calls a truly customer-driven organization. That sounds like a significant shift in emphasis.
It truly is. And I don't think this is just corporate rhetoric. It feels like a logical and necessary progression for a company of their size in today's competitive market. The new strategy is built on 3 strategic pillars.
Okay.
The first is driving smart growth. This means moving beyond just transactional sales, selling a policy, to building enduring customer relationships. Focusing not just on acquiring new clients, but also on cross-selling more products to existing ones and, crucially, retaining them long-term.
So deeper engagement.
It's exactly. Deep engagement and lifetime value, rather than just selling a product and moving on.
And the second pillar, reinforcing productivity, sounds like a continuation of the simplicity at scale idea, but maybe with a more modern, future-focused twist.
It absolutely is. It's about continuing those efficiency gains through further digitization and leveraging that global scale. But now it's about investing strategically in the Allianz brand and, importantly, customer-facing technologies.
Oh, okay.
And here's where it gets really interesting. They're explicitly including generative AI solutions in this. So think smarter operations, not just leaner ones, integrating cutting-edge tech for both efficiency and potentially innovation in how they interact with customers.
Right. And the third pillar?
The third pillar is strengthening resilience. This is a continued, unwavering commitment to disciplined capital management and maintaining a robust financial position. They clearly view a strong balance sheet not just as a defensive measure, but as a prerequisite for both growth and reliability. It's about having the financial muscle to take on new opportunities and weather any storms that come their way.
Now let's zoom out a bit to the broader market, particularly the European insurance sector, where Allianz obviously has its deep roots. It sounds like they're transitioning from a pretty turbulent period of high inflation and rate hikes.
They certainly are. The sector is moving from that time of high inflation and rapid interest rate normalization. Looking ahead to 2025, insurers face a backdrop of somewhat subdued economic growth and, frankly, elevated geopolitical uncertainty. So it's not a completely clear runway ahead. There are still some persistent challenges.
But the shift to higher interest rates, which we've seen globally, that has actually been a net positive for the insurance industry overall, hasn't it? Which might seem counterintuitive to some people.
It has been a significant tailwind. And you're right, it might seem odd at first glance. Higher rates have directly bolstered solvency levels under the Solvency Knoppen regulatory framework. We'll talk more about that later.
Okay.
And critically, they've created really attractive opportunities for insurers like Allianz to reinvest their vast, maturing fixed income portfolios at substantially higher yields than they could just a few years ago.
Ah, so the money they get back from old bonds can be put into new ones, earning more.
Precisely. This directly boosts investment income, which is a critical component of insurer profitability. It's a huge structural benefit for them, playing out over several years.
But on the flip side, we still have this persistent claims inflation to contend with, right? That must eat into those potential profits.
It absolutely does, and it remains a headwind, particularly for their P&C lines. It's driven by ongoing supply chain disruptions, elevated material costs think lumber, car parts, and tight labor markets making repairs more expensive. This means insurers really need strong pricing power and continued disciplined underwriting to maintain their profitability. They have to be able to raise premiums to cover those higher costs.
Makes sense.
However, what's also fascinating is that there's a growing underlying demand for protection. We're seeing more frequent natural catastrophes, unfortunately, and new threats like cyber risks are becoming much more prominent. This is driving people and businesses to seek more insurance coverage.
So demand is up.
Yeah, the European P&C market, for instance, is forecasted to see healthy annual premium growth of around plus 4.2%. That's supported by things like infrastructure and defense investments, and also necessary climate-related premium adjustments as risks increase. So the demand side looks pretty strong.
And are European insurers adjusting their investment strategies in response to these trends, trying to capture more of that higher rate benefit while managing the risks?
Absolutely. We're seeing a clear shift in investment portfolios across the sector. They're moving towards enhancing credit quality, maybe taking slightly less risk there, but also diversifying more into alternative asset classes.
Like what specifically?
Think private placements, infrastructure debt, lending money for big projects like bridges or power grids, and commercial real estate debt. They're actively seeking higher yields and diversification benefits away from the volatility of traditional public markets, trying to optimize their returns in this new higher rate environment. It's a very active, intelligent repositioning of their vast asset base.
Okay, switching gears now to the global asset management side, which is such a key part of Allianz with PIMCO and AGI. It feels like this industry is undergoing constant, rapid transformation. What are the big dynamics at play here?
It absolutely is. The industry is evolving at lightning speed. You've got changing client needs, technological disruption happening everywhere, and let's face it, challenging markets with recurring bouts of volatility. The real insight here, I think, is that large integrated firms, those offering diverse capabilities like Allianz, are gaining a distinct advantage. They can offer a broader spectrum of solutions, blending different strategies and asset classes to meet increasingly complex client demands. Scale matters.
And we're seeing this blurring of lines between different types of investments, aren't we? It's not as neatly categorized, maybe, as it used to be.
Precisely. Managers are increasingly blending listed securities, stocks and bonds you can trade easily and unlisted, or private securities to create more holistic solutions for clients. The goal is better risk-adjusted returns and sometimes managing liquidity differently. Private credit and infrastructure debt, for example, are key growth areas, attracting significant capital inflows because they offer diversification and often higher potential yields than traditional public market investments.
And of course, we can't talk about disruption in any industry today without talking about AI. How is it impacting asset management specifically? Is it just hype or is it real?
Oh, it's very real, and this is where it gets really interesting. AI is transforming the entire value chain in asset management. It's enhancing investment processes, think more sophisticated data analysis, predictive modeling. It's improving back-office efficiency through automation, reducing costs, and it's even personalizing client service through more intelligent chatbots and highly tailored advice platforms.
Right.
An interesting point from the sources is that a great divide is emerging between those firms who really embrace AI and integrate it deeply and those who don't. It's expected to have significant competitive implications down the line.
So it's becoming table stakes almost.
It's moving that way. It's no longer just a buzzword. It's becoming a fundamental differentiator that will likely separate the leaders from the laggards in the coming years. And this raises an important question for you to consider. How quickly and effectively can even large established players like Allianz fully integrate and leverage these powerful technologies across their vast global operations? It's a big challenge.
So investment performance is still crucial, obviously, but maybe it's not the only thing that differentiates asset managers anymore.
That's absolutely right. While strong performance remains foundational, you have to deliver the returns. It's no longer the sole differentiator. Delivering an exceptional client experience is becoming equally, if not more, important.
How so?
Through things like sophisticated distribution channels, highly tailored advice, robust relationship management. It's about the full package, the complete client journey, not just the raw performance numbers on a statement. Clients expect more now.
Now, Allianz, like all European insurers, operates within some truly stringent regulatory frameworks. And two big ones that always come up are Solvency II and the newer IFRS 17 and IFRS 9 accounting standards. For an audience that knows the topic, maybe not intimately but generally, what's the real impact here? Why should we care about these complex rules?
Right, these are indeed complex frameworks, but they actually provide crucial insights once you understand the basics. Solvency this is essentially a risk-based regime. It's designed to ensure capital adequacy, that insurers have enough money, set aside strong risk management practices, and robust governance.
Okay.
It mandates a market-consistent valuation of assets and liabilities, which tries to give a realistic, point-in-time view of their financial health. The Solvency II ratio, which we'll discuss later, is a key metric of resilience derived from this. It shows how much capital a company holds relative to its calculated risks.
And then came IFRS 17, which became effective, January 1st, 2023. This was flagged as a fundamental overhaul of insurance contract accounting. How does this impact our understanding of Allianz specifically?
Okay, here's where it gets really interesting, and maybe where the real aha moment for IFRS 17 comes in for investors trying to understand these companies. This standard significantly enhances transparency and comparability across insurers globally. Its cornerstone is something called the contractual service margin, or CSM.
CSM, okay, what is that in plain English?
Think of the CSM as a liability on the balance sheet that represents the unearned, risk-adjusted future profit expected from a group of insurance contracts. So instead of recognizing all the expected profit up front when a policy is sold,
Which used to happen sometimes, right?
exactly, which made earnings look lumpy. Now, under IFRS 17, this future profit is recognized systematically, smoothly over time as the insurance services are actually provided to policyholders.
Ah, okay, so it smoothed things out.
It provides a smoothed, much longer-term, and significantly more predictable view of earnings power. This is incredibly valuable for understanding the true underlying trajectory of the business, especially in the long-duration life health insurance segment.
So these two complex frameworks, Solvency II and IFRS 17, while perhaps a burden for companies to implement, they actually offer incredibly complementary insights for us as observers, for you listening.
Exactly, they work together. Solvency II gives you that economic point-in-time snapshot. How strong and capitalized are they right now against their potential liabilities based on market conditions? IFRS 17, on the other hand, provides that smooth, longer-term perspective on underlying earnings power and profitability based on the contracts they've already written. A growing CSM, like Allianz has reported $55.8 billion at the end of Q2 2025. That's a big number. Isn't just an accounting figure. It's a direct, forward-looking indicator. Think of it almost like a future profit reservoir that tells us with remarkable precision how stable and predictable Allianz's earnings stream should be for years to come.
That's fascinating.
It's a level of earnings visibility most companies, especially outside the insurance sector, can only dream of. It's a fantastic example of how complex regulations, when properly understood, can provide profound insight into a company's financial future and stability.
All right, let's turn our attention now to the financial pulse of Allianz, because this is where all those strategies, market dynamics, regulations, this is where it really hits the ground and shows up in the actual numbers. Looking back over the last few years, we see a pretty impressive trajectory, wouldn't you say?
Oh, definitely. Impressive is the right word.
What immediately jumps out from their historical performance is just this trajectory of consistent, significant growth. Can you maybe contextualize just how impressive Allianz's top-line expansion has been, especially for a company of its size?
Absolutely. We're talking about a company that grew its total business volume, that's premiums and asset management fees, combined from $140.5 billion in 2020 to a remarkable $179.8 billion in 2024.
Wow.
Now, for a company of this immense scale, achieving a compound annual growth rate, or CAGR, of 6.3% over that 4-year period, that's not just growth, it's a demonstration of their ability to continually expand their footprint and relevance in what's ultimately a mature, competitive global industry.
And this wasn't just revenue growth for the sake of growth. It really translated into a significant acceleration on the bottom line, too, especially more recently.
That's right, and that's key. Shareholders' core net income significantly accelerated in the last couple of years of that period, reaching $10.0 billion in 2024. That came after a period of relative flatness earlier in the decade. Operating profit hit that record $16.0 billion in 2024.
So the profitability really kicked in.
Exactly. It shows that the growth is not just cosmetic top-line expansion. It's translating into real, increasing bottom-line performance, which is exactly what you, as an investor or observer, want to see.
What really stands out to me, though, looking at these numbers, is the surging return on equity, or ROE. I mean, it dramatically improved from single digits back in 2021 to 16.9% in 2024. And it continued to an annualized 18.5% in the first half of 2025. That's a huge leap in profitability relative to shareholder capital.
This is where you really see their strategy paying off. You hit the nail on the head. This remarkable improvement indicates successful strategic initiatives, like that Simplicity at Scale program delivering efficiencies, and the smart pivot in LH products towards higher margin offerings. And critically, it's also been significantly boosted by the positive impact of higher interest rates on their investment income, which we discussed earlier. It signifies a much more efficient and profitable use of shareholder capital, translating directly into enhanced value creation for investors. That ROE figure is a really powerful indicator. Tag B. Segmental profitability and performance drivers. H1 2025 highlights.
Okay, let's try and break down those impressive overall numbers by segment, looking specifically at the first half of 2025 results you provided, and see where the real engines of profitability are running hottest right now.
Good idea. Let's look under the hood. Tag 1. Property casualty P&C outperformance.
The P&C segment, their biggest one, seems to have been a real standout performer recently. We saw operating profit in this segment surge by 12.1% to a record $4.5 billion just in the first half of 2025. That's a powerful contribution to the group total.
It really is. And what's truly indicative of their excellent management here is the improvement in their combined ratio. Now remember, this is essentially how much they pay out in claims and expenses for every dollar or euro of premium they collect. Lower it's better.
Right.
It improves significantly by 1.2 percentage points to an excellent 91.5% in H1 2025. Think of it this way. For every 100 they bring in from P&C premiums, they're spending just 91-point profit margin of 8.50 drives before investment income.
That sounds very healthy.
It's very healthy. And this is a direct result of that strong underwriting discipline we talked about, their successful pricing strategies to counter inflation, and also, it's worth noting, a relatively benign period for large natural catastrophes in the second quarter specifically. It shows they're not just growing the top line, they're growing profitably and efficiently at the core underwriting level. Tag 2. Life Health, LH, profitable growth.
Okay, turning to the life health segment, it also showed continued positive momentum, with operating profit growing by 5% to $2.8 billion in H1 2025. This seems to be building directly on that strategic product pivot we discussed earlier.
Exactly. You're seeing the strategy play out. This continued momentum is underpinned by the success of their strategic shift towards those more capital-efficient and profitable products. Value of new business, or VNB, remember, that measure of future profit, grew by a strong 18% in 2024, specifically driven by that pivot towards preferred product lines like unit-linked and pure protection policies.
So the new business they're writing is more valuable.
Precisely. It's clear evidence that their revised product strategy is generating real sustainable value and moving them away from older products that were perhaps more sensitive to interest rate volatility or required more capital. Tag 3. Asset management, AM, resilience.
And the asset management segment with PMCO and AGI, despite what's often a challenging and volatile market for investment managers globally, has shown pretty impressive resilience, hasn't it?
Absolutely. They attracted a significant $42 billion in third-party net inflows just in the first half of 2025. That follows a massive $85 billion in net inflows for the full fiscal year 2024.
So money is still flowing in?
Big time. This showcases the enduring strength and appeal of PMCO and AGI, demonstrating that even in uncertain times, investors trust Allianz entities to manage their assets effectively, and they maintain a stable operating profit of $1.6 billion in H1 2025, which reflects their resilience even in challenging market conditions, driven largely by those recurring, stable fee-based revenues they earn on the assets they manage. Tag EC. Robust capital strength and solvency assessment.
Now, all this strong financial performance ultimately feeds into a strong capital position, which is absolutely critical for an insurer, right? It's their buffer against unexpected losses. And Allianz's solvency to SEC ratio really stands out as a key measure of their financial health.
It does. It's a crucial metric. At the end of Q2 2025, their solvency to SEC ratio stood at a very strong 209%. Now, for context, this ratio compares the eligible capital an insurer holds their financial cushion to its solvency capital requirement, which is the amount of capital regulators say they must hold to cover potential losses under stress scenarios.
So 209% means?
It means they hold more than twice the capital legally required. This places them comfortably well above their own internal target range and the regulatory minimums, providing a really substantial buffer against any unforeseen shocks, like a huge catastrophe or a market crash.
But it did see a slight decline from the end of 2023, didn't it? It was 229% then. That might raise an eyebrow for some observers.
It did, and it's worth noting. It declined from 229% at the end of 2023 down to 209% at mid-year 2025. According to their reports, this was primarily due to a reduction in what's called eligible own funds, basically, the specific components of their capital that count towards these regulatory requirements. That reduction more than offset the capital generated from earnings during the period. There was also a slight increase in their solvency capital requirement itself, the denominator.
So market movements impacting the value of their capital base.
Likely a key factor, yes. It highlights the sensitivity of their regulatory capital position to market movements, even with generally strong underlying performance. However, what's crucial for you to understand is that despite this dip, a 209% ratio is still very strong, and they continue to maintain top-tier credit ratings, AA from S&P, AA2 from Moody's, and A+ from AM Best.
Yeah.
These ratings consistently reflect their strong overall business profile, their diversified earnings streams, and their robust capitalization. So, while the ratio saw a dip, the fundamental financial strength remains undeniable according to the major rating agencies. #D, balance sheet integrity, and cash flow quality.
So they have this massive and highly diversified asset base exceeding $1 trillion. That's just a huge amount of capital at work on their balance sheet.
It is, but it's not without its specific considerations and, frankly, areas for closer examination by analysts. A 2023 Moody's report, for example, identified what they called a key challenge: elevated high-risk asset exposure, notably equity exposure, compared to peers.
High-risk assets, like stocks.
Primarily stocks, yes, but potentially other less liquid or more volatile assets too. The ratio of these high-risk assets to shareholders' equity was calculated at 233.5% at year-end 2022. Now, this means their balance sheet, particularly the reported shareholders' equity figure, can be quite sensitive to equity market downturns. It's something investors need to keep in mind, as those higher-risk assets could see steeper value declines in a significant market correction compared to holding mostly high-grade bonds.
And speaking of asset composition, there's also a specific data gap concerning commercial real estate, which is definitely a hot topic right now with market stresses in that sector globally.
And this actually highlights another potential blind spot for us as external analysts and for you, the listener, when trying to do a full risk assessment. A significant data gap seems to exist in the detailed composition of their investment portfolio, specifically regarding their exposure to commercial real estate, both the debt they hold and any direct equity ownership.
Why is that important?
Well, given the current global CRE market stress falling valuations, rising defaults in some areas, understanding the precise size, type, and quality of these holdings is crucial for a complete risk assessment. It remains an area of uncertainty where more granular public disclosure would provide a clearer picture of potential vulnerability.
Okay.
However, switching to a very positive note on the balance sheet and cash flow quality, their free cash flow generation is incredibly strong. On a last 12 months basis as of June 2025, it was approximately $34.8 billion.
Wow, that's huge.
It is. And importantly, this substantially exceeds their reported net earnings. This underscores the powerfully cash-generative nature of their underlying businesses, especially insurance. This strong cash flow is fundamental to supporting their substantial capital return programs, dividends, and buybacks to shareholders, which we'll get into next.
Allianz clearly isn't just sitting back and managing its existing book. They seem to be actively shaping their business through strategic portfolio optimization. That involves both shedding assets that don't fit and acquiring ones that do, right?
Exactly. They're constantly tinkering, it seems. For instance, in 2024, Allianz made a very deliberate move by selling its U.S. mid-corp and entertainment insurance businesses, think insurance for mid-sized companies and film productions, to Arch Capital Group. They got $450 million in cash, but also importantly, transferred $2 billion in loss reserves off their books.
Okay, so why do that?
Well, this allowed their main corporate insurance unit, AGCS, to sharpen its focus on the large corporate and specialty segments, where they likely feel they have a stronger global competitive advantage and can generate better returns. It wasn't just selling, it was optimizing their focus and capital allocation.
So while they're shedding some assets, they're also making targeted acquisitions, like their participation in acquiring Viridium Group in Germany. Now, expert, what's the strategic thinking behind a move like that, especially after divesting other businesses? It seems almost counterintuitive.
That's a great question. And it really highlights their agile, maybe even opportunistic capital allocation strategy. Viridium specializes in managing closed life insurance portfolios in Germany. These are blocks of old policies that are no longer being sold, but still need to be administered and paid out.
Runoff business.
Exactly. So acquiring it isn't about expanding into completely new product lines or taking on significant new underwriting risk. It's more about efficiently capitalizing on a growing trend of life insurance consolidation in Europe, where specialized platforms manage these legacy books more efficiently. It allows Allianz to gain exposure to that market and potentially optimize an existing life health business model without taking on excessive new capital risk associated with writing new business. It's a very different kind of play than simply buying a direct competitor writing new policies.
Okay, that makes sense. It's about efficiency in managing old policies.
Precisely. And other actions in H1 2025, like a reported 0.3 billion gain from the UniCredit joint venture disposal in Italy, and a tax provision mentioned for selling their stake in some Indian joint ventures. These are also consistent with this broader theme of streamlining operations, exiting non-core positions, and reallocating capital to higher growth areas or businesses where they have stronger strategic alignment. It's an ongoing, active portfolio management process.
We've mentioned higher interest rates a few times now, and they really do seem to be a double-edged sword for Allianz, don't they? There are clear benefits, especially on the investment side, but also some notable drawbacks, particularly on the balance sheet accounting.
You're absolutely right. It cuts both ways. The primary benefit, and it's a significant structural one, is the impact on their future investment income. Higher rates are a multi-year tailwind for them. As their existing bonds mature, Allianz can now reinvest those proceeds at substantially higher yields than they could just a few years ago. This will gradually but consistently boost their operating profit over time as that higher-yielding portfolio builds up. This is a fundamental positive for their long-term earnings power, essentially giving them a much better return on their enormous pool of investable assets.
But then there's the balance sheet headwind we touched on earlier. We've seen some of these mark-to-market impacts affecting their reported equity.
You're absolutely right. And it's important for you, the listener, to understand this distinction. While higher rates are a tailwind for new investments and future income, they do create a balance sheet headwind for the existing portfolio. Rising rates reduce the current market value of Allianz's existing fixed-rate bonds.
Because newer bonds pay more, so the old ones are worth less.
Exactly. These are mark-to-market losses, meaning on paper, the value of those bonds on their balance sheet goes down. This flows through a part of the accounts called Other Comprehensive Income and directly reduces reported shareholders' equity. Moody's even noted a significant 23% reduction in Allianz's reported equity during 2022, primarily due to this effect as rates shot up.
That sounds bad, but how real is that loss?
That's the crucial nuance. For you, the listener, it's vital to grasp that this is primarily an accounting impact. If Allianz holds these bonds to maturity, as they typically intend to for many of them, they'll still get their full principal back, plus all the promised interest payments. So it doesn't necessarily impact their long-term solvency or the actual cash flow they receive from these assets. However, it certainly can make the reported equity numbers look quite volatile from quarter to quarter, which could be disconcerting if you don't understand the underlying mechanics.
Okay, that's clearer. However, you also mentioned earlier that this higher rate environment has actually fundamentally improved the competitiveness of their life health products. That seems like a major aha moment, a really significant positive swing.
This is a huge positive and perhaps often overlooked amidst the focus on the bond portfolio marks. For years, persistently low, even negative, interest rates made it incredibly hard for insurers to offer attractive guaranteed returns on traditional savings and annuity products. Banks offering simple savings accounts looked relatively better. Now, with significantly higher rates, Allianz can offer much more attractive guaranteed crediting rates on annuities and other savings-oriented life insurance products. This makes them highly competitive again, maybe even more attractive than traditional bank savings accounts for certain customer segments seeking safety and yield.
And this is driving demand.
Absolutely. It has led to what's been described in some reports as run on annuities in some markets as consumers lock in these higher guaranteed rates. And it directly drove that significant 21.6% growth in PVMBP, the value of new business in 2024, for Allianz's LH segment. This really shows how broader market shifts, seemingly just a simple change in interest rates, can directly re-energize entire product lines, dramatically improving their profitability and attractiveness to customers. It's a powerful example of market dynamics playing to their strengths. #C. digital acceleration and AI integration.
Let's talk tech. Allianz clearly views technology not just as a tool, but as a core competitive advantage. They've centralized IT operations under Allianz Technology and are actively investing in innovation through things like Allianz Life Ventures, which targets AI, emerging tech, and new distribution models. How is this strategy translating into actual digital acceleration and AI integration across the group? Is it making a difference?
This commitment to technology seems absolutely pervasive and deeply integrated into their strategy based on the materials. AI, for instance, isn't just some separate R&D project tucked away in a corner. It appears to be being integrated across their entire value chain.
In what ways?
Well, reports mention enhancing underwriting models for more accurate risk assessment and pricing using AI, automating and improving claims processing for faster payouts to customers and reduced internal costs, and increasing productivity and customer service through tools like an enterprise knowledge assistant, presumably an internal AI tool that helps staff find information and answer queries instantly and intelligently.
So efficiency and effectiveness gains.
Exactly. It's not just a fancy add-on. It seems fundamental to their drive for operational efficiency and maintaining a competitive edge in service and pricing.
And it sounds like they're not just dabbling in AI, they're also trying to rigorously quantify its impact and actively preparing their entire workforce for this future. That seems quite forward-thinking for such a large traditional company.
Absolutely. The sources mention Allianz uses a data value metric to actually quantify the financial impact of specific AI projects. This allows them to prioritize investments effectively and ensure they're getting a real, measurable return, not just chasing the latest tech trend. And perhaps even more importantly, they also have extensive AI upskilling programs for their employees, citing things like an AI-run webinar series and professional certifications. This is a crucial insight, I think. It's how a large established company avoids being disrupted and instead builds a future-ready workforce. It ensures they can actually harness the power of these new technologies effectively, embedding innovation into their operational DNA rather than just talking about it as a separate initiative siloed off somewhere. ###HeyITD. Underwriting discipline in an inflationary environment.
We touched on this earlier, but the challenge of claims inflation has been very real for P&C insurers globally over the past few years. Costs for everything from auto repairs to property reconstruction went up significantly. How has Allianz specifically navigated this? Have they managed to protect their margins?
This is where Allianz's renowned underwriting discipline truly shines and seems to differentiate them from some peers based on the results. Their P&C business successfully implemented significant rate increases across their portfolio to offset these rising claims costs. The numbers bear this out. In Q2 2025, for example, their reported 8% internal growth in P&C was composed of 5% from pricing actions, pure rate increases, and only 3% from actual volume growth, meaning selling more policies.
So mostly price increases driving the growth.
Exactly. This clearly demonstrates very strong pricing power, which is absolutely critical in an inflationary environment to protect profitability. They're not shying away from charging appropriate prices for the risks they underwrite, even if it means slightly slower volume growth.
And the proof is in the pudding, so to speak. The combined ratio, which measures underwriting profitability, actually improved despite those inflationary pressures. That's quite remarkable.
Precisely. As we noted, despite those significant inflationary pressures pushing up claims costs, the P&C combined ratio improved to that excellent 91.2% in Q2 2025 and 91.5% for the first half. This indicates that their aggressive pricing actions, coupled with disciplined underwriting, meaning selecting good risks and perhaps some favorable claims development on older policies, more than compensated for the impact of inflation. They actually managed to expand their underwriting margins during this period.
Wow.
This is a very strong signal of effective management and superior execution in a challenging market. It demonstrates their ability to potentially turn industry-wide headwinds like inflation into opportunities for profitable growth relative to less disciplined competitors.
Now, for something that definitely makes you raise an eyebrow and serves as a stark reminder that no company, however large or sophisticated, is immune to significant operational risks. In July 2025, Allianz faced a major challenge. A large-scale data breach at its U.S. life insurance subsidiary, Allianz Life Insurance Company of North America.
Yes, this is a critical development reported in the sources and a very real-world materialization of one of their own top identified risks. According to the information, a malicious threat actor gained unauthorized access to a third-party cloud-based customer relationship management, or CRM system used by the U.S. subsidiary.
And the impact.
The personally identifiable information PII of a majority of its 1.4 million U.S. customers, as well as financial professionals who work with them and some employees, was compromised. That's a significant number of people affected.
And it wasn't necessarily a purely technical hack of Allianz's own systems. The sources indicate it was executed via social engineering targeting that third-party vendor.
Which is a crucial detail.
Yeah.
It highlights the persistent human factor vulnerabilities in the security chain, often involving trusted third-party suppliers, that even the most sophisticated technical defenses can struggle to fully eliminate. This incident, which ironically Allianz itself had identified as the #1 risk globally cyber incidents in its own risk barometer for 4 consecutive years, well, it's now a very real headache for them.
What are the likely implications?
They will almost certainly face significant costs. We're talking about remediation efforts, likely providing credit monitoring and extensive customer support, potential regulatory fines from U.S. authorities, and the distinct possibility of costly class action lawsuits from affected individuals. Beyond the direct financial hit, though, it poses a serious reputational risk. It could potentially undermine customer trust, especially for a company whose entire business is built on trust and security. It's a stark reminder that even industry leaders aren't immune to sophisticated cyber threats and the increasing complexities and risks associated with relying on third-party vendors in the cloud era. This really underscores the importance of operational resilience being just as critical as financial resilience. #VO, pathways to future growth.
Okay, let's shift our focus now from the challenges and current performance to where Allianz sees its future growth coming from. What are the key pathways they're pursuing? One major area seems to be geographic expansion, especially tapping into dynamic emerging markets.
That's right. Targeted expansion in high-growth emerging markets, particularly across Asia-Pacific, looks like a key long-term strategic priority for them. And the rationale is pretty clear. You've got a rapidly rising middle class, increasing personal wealth, and often much lower insurance penetration rates compared to saturated developed markets like Europe or North America. This represents a significant untapped growth opportunity.
And is this strategy already yielding tangible results? Are we seeing growth coming from these regions?
It definitely is, based on the numbers provided. In the first half of 2024, the Asia-Pacific region saw a solid 13% increase in total business volume, reaching $4.3 billion. But perhaps more impressively, the life and health new business value. Remember, that measure of future profitability from new sales surged by 34% to $324 million in that region during H1.
Wow, 34% growth in new business value.
Yeah, that's very strong. And for the full year 2024, the positive trend continued. The region's total business volume grew 15% to $8.8 billion, with that crucial L&H NBV increasing 31%. These are robust growth figures, especially for such a large company, demonstrating the effectiveness of their regional focus in Asia.
And they have a specific strategy in place for the region, don't they? It's not just about opening new offices. It sounds like they're investing in the quality of their sales force, too.
They do. The sources mention a regional strategy called Pinnacle 2030. A key part of this focuses heavily on professionalizing their agency force, the people actually selling the policies, through advanced training programs. They even partnered with prestigious institutions like the INSEAD Business School for some of this training. And this investment seems to be working, as it reportedly led to a 22% increase in new agent recruits in 2024. The insight here for you is that they're investing heavily in the quality of their distribution network, not just the quantity. They're aiming to build a highly skilled professional sales force capable of serving the increasingly sophisticated needs of these growing middle-class markets.
And it's not just Asia, right? They're also making moves in Africa.
That's right. Beyond Asia, Allianz has also significantly strengthened its position in Africa. They did this by increasing their stake in a major joint venture with Sanlam, a large South African financial services group. This move created a combined Pan-African insurance partnership that is reportedly 3 to 4 times the size of its next largest competitor on the continent.
So a dominant position.
It certainly seems aimed at establishing dominance. This is a clear, bold strategic move to capture long-term growth in a continent with enormous demographic potential and currently very low insurance penetration.
Okay, moving back to the asset management division. PIMCO, their huge fixed income specialist, seems particularly well positioned in this higher interest rate environment we've been discussing, right? Bonds are back in favor.
Absolutely. PIMCO is a core strength and directly benefits from the renewed investor interest in fixed income now that yields are much more attractive. They've been attracting significant client assets, likely due to their strong long-term performance track record and deep expertise in navigating complex bond markets.
Mm.
However, a major strategic priority for the asset management division as a whole, beyond just traditional bonds, is expanding aggressively into alternative investments.
Alternatives like,
Things like private credit lending to portfolio companies instead of them issuing bonds, infrastructure debt, private equity, basically less liquid investments outside of public stock and bond markets. This is a structurally growing area as institutional investors and even high net worth individuals seek diversification away from public market volatility and potentially higher returns, although often with less liquidity.
and this alternatives business is already becoming a significant growing part of their results. It's not just a small side business.
Yes, the reports state it accounts for an increasingly larger share of the overall asset management results. Allianz GI, their other main asset manager, for example, is actively expanding its infrastructure debt platform and moving into higher-yielding opportunistic credit strategies, really trying to cater to that evolving client demand for these less liquid, potentially higher return investments.
Do they have specific targets for this?
They do. The segment overall aims for an ambitious operating profit of approximately $4 billion by 2027. That's up significantly from the $3.2 billion in 2024. And this growth is expected to be supported by an 8% compound annual growth rate in third-party assets under management. So, yes, this is a clear, ambitious target for future performance, signaling strong confidence in both their traditional strengths and this push into alternatives. ###C, digital platforms and Insurtech synergies.
Now, Allianz isn't just relying on traditional growth channels like agents or acquisitions. They also seem to be actively building and scaling their own digital platforms. These almost act as both direct growth engines and internal innovation labs for the broader group, don't they?
This is a critical insight, I think, into how a large, established company like Allianz tries to stay agile and innovative in the face of digital disruption. Two prominent examples mentioned are Allianz Partners and Allianz Direct.
Tell us about those.
Allianz Partners is a global leader in what's called B2B2C insurance and assistance services. Think travel insurance you buy with your flight, international health plans for expats, roadside assistance programs bundled with car sales, often white-labeled or co-branded with other major companies. This business is actually substantial, surpassing $10 billion in revenue in 2024, showing its significant contribution to the group.
Okay, so that's more business-to-business partnerships. What about Allianz Direct?
Allianz Direct is their online-only P&C insurance platform. This is aimed squarely at capturing direct-to-consumer growth, competing with newer digital native insurers. And it's experiencing rapid growth, with revenues reportedly expanding 22% in the first half of 2025.
So what's the broader strategic importance of these digital platforms for Allianz as a whole?
Well, their strategic importance is manifold, really. First, they provide direct customer access, bypassing traditional intermediaries. This generates incredibly rich data about customer behavior and preferences, which is invaluable for refining product development and pricing across the entire group, not just within those units. Second, they allow for much faster testing and scaling of new technologies, new products, and new business models compared to the core legacy businesses. They can experiment more freely. This creates a valuable feedback loop, where successful innovations piloted in these digital units can then potentially be integrated back into the core businesses, driving broader digital transformation across the whole organization. It's how they try to avoid becoming a complacent incumbent and instead position themselves closer to the forefront of industry change.
Okay, for you, the listener, particularly if you're an investor or potential investor, understanding how a company like Allianz manages its capital and returns value to its shareholders is absolutely paramount. And Allianz seems to have a pretty clear, consistent, and frankly generous approach here, driven by that strong cash flow we talked about.
Yes, their dividend policy is a key pillar of their shareholder return strategy. They recently took a significant step by increasing their regular payout ratio from 50% of net income attributable to shareholders up to 60%.
That's a big jump, 60% payout.
It's a very clear, powerful commitment to shareholder yield. It signals strong confidence from management in the sustainability and future growth of their earnings.
And their policy isn't just about the payout percentage. It's explicitly progressive and designed to be reliable, isn't it?
Exactly. That's a crucial feature. Their stated policy commits to at least maintaining the prior year's dividend per share. This creates a strong expectation for investors of stable to reliably rising dividends over time, barring major unforeseen crises.
And their track record backs this up.
It backs it up impressively, especially recently. The dividend per share was increased by a substantial 21.1% to 13.80 for the 2023 fiscal year. And then it was increased again by a further 11.6% to 15.40 for the 2024 fiscal year. This demonstrates considerable confidence from the board in their sustainable earnings power and a clear desire to share that success directly and generously with investors through cash dividends.
Now, beyond those significant dividends, Allianz has also been very consistent and quite aggressive with share repurchase programs or buybacks. This is another key lever they pull for value creation.
They have a long and substantial history of this, yes. The sources state that between 2017 and 2024, Allianz completed 11 separate share buyback programs, repurchasing a total of 14 billion AS worth of its own shares over that period.
14 billion euros. That's a lot of shares taken out of the market.
It really is, and it's ongoing. For 2024, a 1.5 billion program was executed. They actually expanded it from an initial 1 billion target. And for 2025, a new program of up to 2 billion is currently underway, with 1.0 billion of that already completed in the first half of the year.
So why do companies do this? How does it create value?
What's crucial here for you to understand is that typically all the shares Allianz repurchases are subsequently canceled. They don't just sit on the balance sheet. Canceling them permanently reduces the total number of shares outstanding in the market.
So the ownership pie is cut into fewer slices.
Exactly. Which means that the company's total earnings are divided among fewer shares. This provides a direct mathematical uplift to earnings per share, or EPS, for all the remaining shareholders. It's a tangible, quantifiable way to create per-share value for long-term investors, alongside the dividend. #C, balancing reinvestment and capital returns.
So when you put together this high dividend payout now, targeting 60% of net income and these large recurring share buybacks, it tells us something very important about their free cash flow generation relative to their investment needs, doesn't it?
It absolutely does. This combination strongly indicates that Allianz is truly what you might call a cash flow compounder. They consistently generate free cash flow well in excess of what they need for organic growth initiatives within the business and for their targeted strategic M&A activity, like the Veridium deal we discussed.
They generate more cash than they can reasonably reinvest in the business itself at attractive returns.
That appears to be the case. And this strong financial profile means shareholders benefit from a powerful dual-engine return. You get the high and growing dividend yield, which provides attractive current income, and you get the steadily decreasing share count from buybacks, which enhances the per-share value and future growth potential of the enterprise over the long term. This combined financial profile makes Allianz very attractive for investors focused on total shareholder return.
And this overall capital return strategy also suggests a very disciplined approach to capital allocation by management and the board.
Indeed. It suggests that, in their current assessment, returning significant amounts of capital directly to shareholders through both dividends and buybacks is considered one of the highest return uses of their capital right now. This indicates a disciplined and clearly shareholder-focused allocation strategy. They seem to be prioritizing consistent, tangible returns for investors over potentially pursuing very large, potentially risky, transformative acquisitions that might not deliver the same level of predictable value creation. It's often seen as a hallmark of a mature, well-managed, cash-generative company.
Now, for you, the listener, trying to figure out if Allianz is attractively priced, understanding how a complex conglomerate like this is valued is crucial. It's definitely more than just looking at a single price-to-earnings ratio on a stock screener.
Precisely. Valuation here requires a multifaceted approach. As of August 2025, the data provided shows Allianz, ticker ALV.XETRA, had a PE ratio of about 14.45 and a forward dividend yield of around 4.13%. Now, are those numbers good or bad?
Right. How do you know?
Well, to truly understand whether these are attractive, you absolutely need to compare these current trading multiples to Allianz's own historical ranges over, say, the last 5 or 10 years. And, just as importantly, you need to compare them to a relevant peer group.
Who would be in that peer group?
Major global insurance and asset management players like AIG, AXA, Chubb, Generali, Zurich Insurance, and perhaps even the reinsurer Munich Re, which is also based in Munich. This comparative analysis helps determine if the market is currently valuing Allianz's earnings and dividends appropriately relative to its own history and its closest competitors.
And given its conglomerate structure with those 3 distinct pillars, P&C, LH, asset management, the sum of the parts, or SOTP, valuation seems particularly relevant here, maybe even necessary to uncover potential hidden value.
It's highly relevant, yes. An SOTP methodology involves valuing each distinct business segment P&C, LH, and asset management individually, using the valuation multiples that are most appropriate for that specific industry.
So different multiples for different parts.
Exactly. For example, you might use price to book value or price to earnings for the insurance businesses, but perhaps price to assets under management, AUM, or price to revenue for the asset management segment. You then aggregate the estimated values of these individual segments and adjust for any central corporate costs or assets liabilities held at the group level.
And what can that tell you?
This kind of analysis can be incredibly insightful. It can reveal if the current market price of the consolidated Allianz stock is fully valuing all of its diverse businesses, or if perhaps a conglomerate discount exists, where the market undervalues the combined entity compared to what its individual parts might be worth if they were separate companies.
We also need to consider the quality of their book value, especially with the insights provided by that new IFRS 17 accounting standard and the CSM metric we discussed. It's not just about the reported equity number anymore.
This is a crucial point for the sophisticated investor looking at insurers today. While the IFRS reported shareholders' equity figure can be quite volatile due to those interest rate mark-to-market impacts on the bond portfolio, remember that 23% reduction Moody's noted in 2022. The robust and growing IFRS 17 contractual service margin, CSM, that $55.8 billion future profit reservoir, provides a much more stable proxy for the underlying value creation happening within the LH business. It also offers incredible visibility into future earnings streams. This CSM metric, in many ways, transcends the limitations of traditional, more volatile book value figures, offering a deeper, more predictable view of the long-term economic health and value embedded in the insurance book.
And finally, that substantial dividend yield we discussed also serves a practical role here as a valuation anchor, doesn't it? It absolutely does. With a forward dividend yield currently sitting above 4%, combined with that explicit progressive policy aiming to maintain or increase the payout each year, that substantial and reliable dividend provides a crucial valuation anchor for the stock. It offers attractive current income, which appeals to many investors, and it can potentially act as a valuation floor, providing some downside support, especially in volatile market conditions. It makes the stock inherently appealing for income-focused investors who value predictability and cash returns.
Okay, so we've covered the immense strengths, the strategic evolution, and the significant opportunities for Allianz. But, for a global giant operating across so many complex domains, the risk landscape they face is just as vast and intricate. We have to look at the other side of the coin. Let's talk about some of those critical headwinds and potential vulnerabilities. Tag A, underwriting and catastrophe risk exposure. Yes, absolutely. You can't analyze an insurer without deeply considering the risks. And as a leading global property insurer, Allianz is inherently exposed to the increasing frequency and severity of natural catastrophes, NatCats. Think hurricanes, floods, wildfires, severe convective storms. The list goes on.
And this isn't just a theoretical concern on the horizon. It's a recurring and material driver of earnings volatility now, hitting the industry hard year after year.
That's exactly right. And it's not just external analysts like us saying this. Allianz's own internal risk assessments clearly reflect this growing concern. What's particularly telling here is that Allianz's own group risk barometer for 2025 ranked natural catastrophes as the #3 most significant business risk globally, as perceived by risk experts themselves.
Wow, number 3 globally.
Yeah, and the context is stark. The global insurance industry sustained over $100 billion in insured NatCat losses for the 4th consecutive year in 2023 alone. These are becoming consistently huge numbers.
And it's not just the immediate impact of individual events, but the longer-term trend of climate change itself that's structurally reshaping the risk landscape they have to underwrite.
Precisely. Climate change itself ranks as the #5 global risk in that same Allianz barometer. This indicates a broad consensus, even internally within one of the world's largest insurers, that the fundamental risk landscape is structurally shifting due to climate factors.
So what does this mean for Allianz?
Well, it necessitates continuous refinement of their sophisticated catastrophe risk models. It demands extremely disciplined underwriting, deciding which risks to take and at what price. And it requires sophisticated reinsurance strategies to transfer some of that peak risk off their own balance sheet. Now, while they've shown an ability to price for this increased risk over time, the inherent nature of catastrophes means that a single, unprecedented megacat event or a cluster of very large events in one year could still significantly impact their earnings and potentially their capital position. It highlights an inherent, persistent vulnerability that even the most robust mitigation strategies can't entirely eliminate. Be market and interest rate sensitivity.
And beyond underwriting risk, with over $1 trillion in total assets on their balance sheet, Allianz is effectively a massive institutional investor itself. This means its balance sheet health and its earnings are highly sensitive to swings in global financial markets. That's a huge amount of exposure to manage day to day.
That's a huge understatement. It's an enormous exposure, and this market sensitivity plays out in several critical ways. We've already discussed interest rate risk quite a bit. Rising rates benefit their future reinvestment income, but cause those mark-to-market losses on their existing bond portfolio, hitting reported equity. Conversely, a sudden sharp fall in rates would reverse this error. It would boost the value of their existing bonds on paper, but compress their investment margins on new money going forward. It's a constant balancing act.
Right. And it's not just interest rates, is it?
No, not at all. Then there's credit risk. If we were to see a severe global economic downturn, that could lead to significant credit losses in their vast corporate bond portfolio if companies start defaulting on their debt payments. And finally, there's equity market risk. Their substantial investments in stocks mean that a major market downturn, a crash or prolonged bear market, could result in significant investment losses, again impacting the reported shareholders' equity and potentially their capital ratios.
So managing all these interconnected market risks, interest rate, credit, equity across such a massive global portfolio must be an incredibly complex undertaking.
It is. It's core to what they do. Allianz employs a highly sophisticated asset liability management, or ALM, framework to try to navigate these exposures effectively. This involves meticulously matching the characteristics, like duration and cash flow timing, of their assets with their insurance liabilities. They also use financial derivatives strategically to hedge specific risks where appropriate.
And does it work?
Well, it's a constant challenge, but the rating agencies seem to think they do it well. Fitch, another prominent rating agency, specifically noted in a report that Allianz successfully managed the particularly challenging macro environment of 2022 when we saw both stocks and bonds fall sharply, precisely because of its robust risk management capabilities and sophisticated ALM framework. That external validation is a real testament to their expertise in this complex area. #C, regulatory, geopolitical, and operational headwinds.
Now, operating in over 70 countries, as we established, also means Allianz is exposed to a wide and ever-changing kaleidoscope of regulatory and geopolitical risks. That must make their operating environment incredibly complex from a compliance and planning perspective.
Indeed. The regulatory burden alone is immense. In fact, changes in legislation and regulation is ranked as the #4 global business risk in that same Allianz Risk Barometer for 2025. This includes things like the ongoing evolution of the Solvency II capital rules in Europe, new consumer protection laws constantly emerging in various jurisdictions around the world, and rapidly increasing sustainability reporting requirements, like the Corporate Sustainability Reporting Directive, CSRD, in Europe, which demands much more detailed disclosure on environmental, social, and governance factors. Keeping up with all that globally is a huge task.
And then layered on top of that, you have the geopolitical instability we see around the world.
Exactly. Acute geopolitical risks are a major concern. Things like potential trade wars disrupting global commerce, regional conflicts flaring up, civil unrest impacting specific countries. These can disrupt supply chains, which can lead to business interruption claims for their P&C clients. They can also cause broad financial market volatility, impacting their investment portfolio. These external factors are incredibly difficult for any single company to control, but they require constant monitoring, sophisticated scenario planning, and an agile ability to adapt strategy quickly. #D, cybersecurity and technological disruption. The #1 risk.
And this brings us back full circle, almost, to what Allianz itself identifies consistently as its #1 risk globally, cyber incidents. As we mentioned, it has ranked as the top global business risk for the 4th consecutive year in their own risk barometer, with large-scale data breaches being the most feared specific scenario. This is clearly the recurring theme that keeps their risk managers up at night.
And this risk, as we unfortunately had to discuss earlier, materialized internally in a very significant way in July 2025 with that large-scale data breach at its U.S. life insurance subsidiary. The compromise of personally identifiable information for a majority of its 1.4 million U.S. customers, plus financial professionals and some employees, via that third-party CRM system, apparently executed through social engineering. It's deeply concerning and directly validates their own top risk assessment in the worst possible way.
And this creates a potentially stark contradiction, doesn't it? For a company that positions itself globally as a cyber risk leader, actively selling cyber insurance policies and risk management expertise to other
It
corporations.
certainly does. It's an awkward position, to say the least. Allianz positions itself as a thought leader in cyber risk, advising and insuring other companies against these very threats. Yet its own defenses, or at least those of a key subsidiary relying on a third-party vendor, were breached.
So the impact goes beyond just the direct costs.
Absolutely. This incident not only creates potentially very large direct financial liabilities for remediation, customer support, likely regulatory fines, and almost certain class action lawsuits, but it also poses significant reputational risk. It could potentially undermine their credibility in the very cyber insurance market where they aim to be a global leader.
Right.
It underscores very powerfully that operational and technological risks, particularly sophisticated cyber threats, often involving the extended supply chain, are just as significant and potentially impactful as the traditional underwriting and market risks for a company of this scale. It challenges even the most robust systems and highlights that no one is immune. Hashtag tag tag outro.
Well, we've just completed a really significant deep dive into Allianz SE today. We've
Mhm.
explored its incredible 135-year legacy, its highly diversified financial services model, and how it's actively trying to navigate a truly complex and rapidly changing macroeconomic landscape.
Yeah, we've seen evidence of record profitability, a clear strategic pivot towards becoming more customer-centric to drive future growth, and a very strong, consistent commitment to shareholder returns through both substantial dividends and large-scale share buybacks.
Hmm.
But, importantly, we've also looked squarely at the very real risks they face. From the increasing frequency and severity of natural catastrophes impacting their core insurance business, to the inherent volatility of global financial markets affecting their massive investment portfolio, and of course, to that surprising and significant cyber breach that occurred right in their own backyard, so to speak, at their U.S. subsidiary.
It really feels like Allianz, despite its vast scale, its deep experience, and its proven resilience over more than a century, faces this constant, delicate balancing act. It's about leveraging its immense strengths and accumulated expertise to capture new growth opportunities, particularly in emerging markets and digital channels, while simultaneously and perhaps increasingly urgently fortifying its defenses against an ever-evolving array of risks. Risks that seem to be becoming more complex, more interconnected, and, as we've seen with the data breach, sometimes hit much closer to home than perhaps anticipated.
So as you, our listener, reflect on this deep dive into this global financial giant, perhaps consider this final thought. How effectively can a company that specializes in analyzing, pricing, and insuring against risk for others ultimately insure itself? Insure itself against the very real, often surprising, and sometimes even self-inflicted vulnerabilities of our incredibly interconnected, technologically dependent, and rapidly changing world.
That's a fascinating question.
It's a question that challenges even the most robust systems, the most experienced management teams, and the most resilient companies like Allianz. Something to ponder.